PayPal, ticker symbol PYPL, operates a payment system that is used to process online purchases and sales. As the undisputed market leader in online payment, the former eBay subsidiary now has over 350 million active member accounts in around 200 countries. Compared to the previous year, this is an increase of a whopping 21%. If you've ever bought anything online, you'll surely have come across PayPal. Similar to credit card companies, PayPal earns a small percentage on every single transaction, and that really adds up because in the fourth quarter of 2020, PayPal's net payment volume amounted to around $277 billion, representing a 39% year-on-year growth. This payment volume was generated through the over 3.74 billion transactions which PayPal processed during that period. In this video, we're going to take a closer look at some of the things that make PayPal so successful, the company's main business model mechanisms, its future strategy, strengths, weaknesses, opportunities and threats, its fair valuation, and as a newly added feature to my videos, we'll see how well PayPal does on the standardized scoreboard. Finally, I'll give you my take on whether the company is a buy at the moment. Welcome to Good Stocks. About 8 to 10 hours of research go into each one of my videos so that I can provide you with the most valuable information in under 15 minutes. So please consider subscribing for more content like this. And without further ado, let's jump right into it. PayPal has a decisive competitive advantage over the numerous other payment options on the internet. For example, the number of customers who abandon the purchase process during payment is far lower than with the competition. The so-called checkout conversion rate, or in other words, the completion rate of order processes, hovers at around 88.7%. For comparison, for credit card payments, about every second payment is cancelled online while the information is being entered. The reason for PayPal's success is primarily the ease of use for customers. With the so-called one-touch procedure, for example, they no longer have to re-enter their password and username if the data has already been linked to the customer account of the online shop. The address data stored in the PayPal account enable the user to shop online without the tedious task of data entry or registration. With a confirmation click, the ordered goods are simply sent to the address saved with PayPal. This function is especially useful for smaller web shops where the conversion rate is especially low during checkout. Online merchants want to implement the checkout payment options that are convenient for their customers and improve their conversion rates, and PayPal lets them do this. With a single integration, PayPal Checkout lets customers pay with PayPal, Venmo, PayPal Credit, and major credit and debit cards, all without ever having to leave a merchant's website. And the technology behind PayPal Checkout automatically shows customers the most relevant payment options. For this reason alone, the company will continue to steal market share from credit card companies. After all, who'll still need plastic cards in the coming years when it is much easier and even safer to use a smartphone or the internet? At the beginning of 2018, the auction and shopping platform eBay announced that it would gradually end its relationship with the former subsidiary PayPal and work more closely with the Dutch provider Adyen in the future. The stock market was disappointed at first because around 13% of PayPal's sales came from eBay at the time. However, the spin-off also had its positives. The payment provider is no longer chained to the old parent company and can form new alliances, for example with Amazon. Incredibly, PayPal now actually even surpasses eBay in terms of market capitalization. With a market value of $274 billion, PayPal is already worth more than 7 times as much as eBay, which has a market capitalization of only $39 billion. In my opinion, PayPal has one central task: creating network effects. In order for this to work out, PayPal has to optimally serve two target groups, the consumer and the online retailer. The more merchants integrate PayPal as a payment option, the more valuable PayPal becomes for consumers. The more consumers use PayPal, the more merchants integrate PayPal. This is the flywheel of self-reinforcing network effects. PayPal's advantages from the consumer's point of view come from 4 main sources. First, buyer protection. Buyers can withdraw their payment at any time if the retailer is fraudulent. Second, simplicity. PayPal is easy to use, both on PC and on the phone. Third, coverage. PayPal has a high level of coverage because customers want to pay in as many places as possible with as few payment service providers as possible. Fourth, sending money to friends without incurring costs. The last point in particular is quite inconspicuous. After all, PayPal doesn't even earn any money from it. If anything, it incurs a slight financial loss. So why is PayPal doing this? Because of network effects. Through this service, PayPal manages to bring users to the platform. Anyone who creates an account to send friends money or to receive money from friends is much more likely to pay for online purchases via PayPal in the future. In my opinion, strategically, this is extremely smart. PayPal's advantages from the retailer's point of view come from three main sources. First, inexpensiveness. PayPal processes payments for much lower rates than other providers. Second, speed. PayPal pays out money quickly so businesses can maintain their liquidity. Third, checkout conversion. The simpler the ordering process, the more customers make online purchases. The more trust, the easier the ordering process, and the more flexible the payment options, the better for the online seller. The bottom line is that PayPal has to get as many customers and as many companies as possible onto the platform by fulfilling and developing the listed factors as best as possible. And so far, it has been quite successful since the number of active member accounts has increased drastically over time. So what have we learned so far? PayPal earns money through commissions on processed payments. The company is growing fairly steadily at around 20% per year. In addition, PayPal is profitable. Its most important strategic focus is the number of users and building network effects. Alright, so now that that's out of the way, let's get on to the next segment. There are two really exciting things happening at PayPal. First, Buy Now, Pay Later. PayPal recently launched the Buy Now, Pay Later feature in the United States and the United Kingdom. Customers can thus separate the time of purchase from the time of payment, for example in the form of installment payments, which PayPal then processes. The merchants still get the full amount paid by PayPal at the beginning. Second, buying cryptocurrencies through PayPal. Cryptocurrencies, especially Bitcoin, are currently experiencing a boom again, perhaps also through PayPal, which announced a few months ago that it would make it possible to buy and store cryptocurrencies in so-called wallets. These two developments open up new sources of revenue for PayPal and can bring millions of new users onto the platform. So where are the opportunities for the company to grow and create even more value? Well, first, there's the entry into the cryptocurrency space. By enabling cryptocurrencies, PayPal can tap into new revenue potential on the one hand, but also attract new customers who prefer to rely on PayPal rather than some unknown crypto trading venue when looking for a secure way to buy their first Bitcoin. Beyond that, I like how future-proof PayPal is setting itself up to be. No matter how payment is made, PayPal is in the market. Second, being part of a growing market. In principle, the market for payment processing is growing pretty much in line with economic growth. However, the market for digital and especially mobile payment processing is growing even faster as payments are changing from offline cash payments to online payments. Most recently, the annual growth of the digital payment market was 12%. Every company faces risks, such as a weakening economy, operational missteps, political intervention, and others. But now we're going to analyze what specifically could jeopardize PayPal's success. The biggest threat right now lies in the GAFAs entering the market. GAFA consists of Google, Amazon, Facebook, and Apple. All of these companies have direct access to the consumer, often before any other company. And now they offer payment solutions that they can place concomitantly before anyone else. Apple Pay and Google Pay are optimally integrated into the smartphone as Apple and Google provide the operating systems iOS and Android for this. Facebook Pay is still very small, but Facebook wants to continue working on it, for example, by enabling direct checkouts on Instagram or payments via WhatsApp. Amazon also has its own payment solution with Amazon Pay, which is now also offered outside of Amazon. The GAFA companies have an unfair advantage. They have customer access, which makes it much easier for them to conquer the payment market than for PayPal, for example. Still, Apple Pay has the problem that only about 25% of smartphone users have iPhones. Google Pay has a larger market share on smartphones via Android, but again, it is barely established on computers. Facebook Pay is still hardly used and has its first launches in emerging markets, but it also has to get to grips with people not really trusting it. Amazon Pay is hardly represented in mobile payment, and it is integrated primarily in stores, which are increasingly skeptical due to Amazon's bargaining power. So GAFA competition is real, but there are definitely some hurdles. Many of them are also focused on pure commercial payments, while PayPal offers many more services such as sending money to friends, collecting money, buying cryptocurrencies, buyer protection, etc. Some companies are developing their own payment processing solutions. For example, Shopify is developing a solution with Shopify Pay, which developed stores can then use and integrate through Shopify. Of course, this is not quite as simple. Even such a payment service must first be established and collect trust, which PayPal has already built up over years and even decades. To find PayPal's fair value, we're going to take a look at its Peter Lynch fair value, as this applies perfectly to growing companies. The ideal range for the growth rate is between 10 and 20% a year. Peter Lynch thinks that the fair PE value for a growth company equals its growth rate, that is PEG equals 1. The earnings here is trailing 12-month earnings. For non-bank companies, the growth rate we use is the average growth rate for EBITDA per share over the past 5 years. If the 5-year growth rate is greater than 25% a year, we use 25. If the 5-year growth rate is smaller than 5% a year, we do not calculate Peter Lynch fair value. Here as of today, PayPal's holdings PEG is 1. PayPal 5-year EBITDA growth rate is 22.04. PayPal's earnings per share without non-recurring items for the trailing 12 months ended in December 2020 was $3.54. Therefore, the Peter Lynch fair value for today is $78.02. As of today, PayPal's share price is $247. Therefore, PayPal's holdings price to Peter Lynch fair value ratio for today is 3.17. As we can see, PayPal can be considered overvalued. However, this should not make you all too concerned, as many great companies such as Tesla or Netflix have been considered overvalued for years, and yet they've managed to provide investors with a very nice return. Now let's get to our scoreboard. PayPal's earning power is very solid. The company is profitable with over $4.2 billion in profits last year. Its return on assets of 5.97% and return on equity of 20.94% are among the best of the industry. Its profit margin of 19.59% is outstanding for a growth company, and its annual free cash flow for 2020 was $5.8 billion, which is a 50% increase from 2019. So for this category, PayPal gets a nice round 20 out of 20. PayPal's business model is also very solid. It is one of the leaders in the digital transaction space, and it is constantly adding new valuable functionalities, such as the possibility to buy, hold, and pay with cryptocurrencies or paying in installments. The only drawback is that PayPal is very dependent on network effects, which are expensive to achieve. However, I would say that PayPal has reached the critical mass for the most part, so I'm certain that PayPal is here to stay and will continue to attract more users onto its innovative platform. I give PayPal an 18 out of 20. When it comes to past growth and further growth potential, PayPal is also very strong. It has consistently increased its number of users, and the digital payment space is poised to grow even further, and PayPal with it. There are some companies such as Square that have experienced even greater growth over the past year. However, much of this is due to Square's dependency on cryptocurrencies. I have to say that I prefer a slower growth rate over the riskiness of being too involved in just one sector. So here PayPal gets a 19 out of 20. PayPal is facing quite a few risks right now, especially concerning the entry of Amazon, Google, Apple, and Facebook into the digital payment space. As more and more companies discover this market's potential, it is likely to get more crowded. However, PayPal has the clear advantage that it is usable on any platform, whereas especially Apple and Google are rather restrained to their ecosystems. Nonetheless, I have to give PayPal a 9 out of 20 just because these competitors are some of the most difficult to take on, as they have almost unlimited resources. As I mentioned before, PayPal is currently overvalued, which should not come as a surprise to anyone who's ever invested in a growth stock in the last year. However, this still means that the stock's upside potential could be limited. If you expect a 20 to 30% return over the next year, this stock might not be for you. However, if you want to invest in a solid company that will continue to grow at a steady rate and provide lots of value to its users, then PayPal is definitely the right choice. PayPal gets a 12 out of 20. This brings us to a total of 78 points out of 100, which is in our buy zone. In conclusion, I think that PayPal is a high-quality, exciting, and future-proof company. There are strong competitors, but the payment market is very large, and PayPal is well-positioned. However, in my view, the valuation is currently a bit too high to expect an attractive return. As an investor, you can of course find other stocks that are also strongly positioned in payments, Alibaba and Tencent for China, or for example Visa or Square for the Western nations. Square in particular is growing significantly faster than PayPal in terms of revenue at around 40%, but is valued at almost the same PE ratio. But over 50% of the revenue growth comes from Bitcoin trading. That can be an opportunity, but more importantly, it can be a significant risk. Therefore, PayPal is the somewhat safer, established option, even if there are stronger growth companies in the market. Let me know in the comments if you guys think that PayPal is at a good buying point right now, and whether investors should be concerned about GAFA entering the market more heavily. As always, thanks for watching, and see you next time.